So, how do we distinguish between the payment structure and collateral structure of a securitization backed by amortizing assets and non-amortizing assets? Amortizing assets are loans for which the borrower makes periodic scheduled payments that include both principal and interest. The interest amount is subtracted from the total payment, and the balance is applied towards the principal, reducing the outstanding loan. Amounts in excess of the scheduled periodic payments are applied to a further reduction of principal. Such additional payments are called prepayments. A residential mortgage is an example of an amortizing loan. Non-amortizing assets are loans that do not have scheduled payment amount. Instead, minimum payments, which are applied against accrued interests, are required. If the minimum payment exceeds the accrued interest, the excess is applied towards reducing the outstanding principal. If the payment falls short of accrued interest, the outstanding loan is increased by the amount of the shortfall. Basically, a revolving credit card is an example of a non-amortizing asset. The structure of the asset-backed security transaction is affected by whether the assets backing the bonds are amortizing or non-amortizing. For amortizing assets, like auto loans, once the assets are securitized, the composition of the loan in the pool does not change. Loans disappear from the pool as they are paid off or default, but no new loans are added to the pool to replace them. Principal payments and prepayments on the remaining loans are distributed to the bondholder according to the distribution rules of the structure. For non-amortizing assets like credit card receivables, however, the composition of the loans in the pool can and does change. During the lockout period, for example the first 18 months, principal payments and prepayments are not distributed to the bondholder, as in the case with amortizing assets. Instead, the cash flow from these principal payments are used to invest in new loans to replace the amount paid off. This type of structure is called a revolving structure. The bonds issued in a revolving structure can be retired early under certain conditions by requiring cash flows to be directed to the reduction or principal rather than the purchase of new loans. The call provision can be triggered by several different types of events. A specific date is reached, for example, a call on or after a specific date, much like a typical callable corporate bond. Also, the collateral value can fall below a certain level, for example, 10% of the original outstanding balance, and this is actually referred to as the optimal cleanup call provision. Or, in another case, a specific date is reached and the collateral balance reaches a specific level. This is called the ladder of percent or date call. And the collateral's cumulative loss history can reach a certain level. This is referred to as an insurer call. Okay, this was distinguishing between the payment structure and collateral structure of a securitization backed by amortizing assets and non-amortizing assets.